Aloha, big wave trading family. I hope everyone is having a nice 3-day weekend. Want to go over the market really quick. It's been pretty impressive, the overall rally off that break of new lows in February, testing the 200-day moving average and rally for the S&P 500. However, we know V-shaped rallies are never healthy, especially whenever you're looking for a follow-through day and you don't even get a down day before the follow through day, which we had here on Wednesday. So we really can't judge the level of selling that's still out there. So overall, if you look at this chart, you'll see the S&P 500 is coming into some pretty key short-term resistance areas. So the moment of truth is now here. How we reverse from these highs will tell us if we're going to probably retest the lows and or consolidate and break out to new highs. I have an open mind here because the yield curve isn't completely inverted. So without the yield curve being inverted, it's hard for me to think that, a new bear market's going to happen here. What I would think, though, is that more consolidation and chop is needed. But we did reverse on Friday off those intraday highs on heavier volume than we saw the entire rally since day one on the S&P 500. So keep that in mind. The NASDAQ is in similar situation, but it broke through my key resistance lines, but it reversed on Friday on heavier volume right after doing it the day before. So we'll continue to monitor that, see how it goes. Dow Jones Industrial Average got through one of my short-term trend lines, but reversed at the other one. Heavier volume on that reversal also. So once again, very problematic. And the IWM, Russell 2000, similar situation. Right, it got through my first downtrend line, but these are very severe trend lines, and now my second short-term trend line, a reverse right at it. Volume was having a session before. It doesn't mean, though, that we're definitely going to retest these lows here, but no matter what, I would think now we're going to need to consolidate or chop, and you better hope we do, because we still have 2 weeks of February to go through, and seasonality-wise, you want us to continue to pull back during the poor seasonal period so that we're coiled up and ready to explode higher from March to May during our seasonally bullish time of the year. If we V-shape rally all the way into March, you know it's not a good, I guess, launching pad to have a rocket lift off from. So we need to continue to monitor that. You're going to hopefully, if you're an intelligent trader here and you understand the markets and understand the rally attempt we just had from the February lows, you know that it's not an all clear sign yet. You don't want this market to continue to move higher. You want it to consolidate so then we can see what are the strong stocks and what are the weak stocks. And on that end, I actually have 6 new long positions for Tuesday. But are any of them great? No. Force a gun to my head, taking a trader's small account that may have to pay $5 commission to get in a trade and then another $5 to get out of a trade. Would I take any of these trades? Absolutely not. I wouldn't take a single one. But as it is with a larger sized account with a very low commission cost, $1 per trade, I figure if this market does want to continue to ramp up to new highs, might as well test them out since the recent ones are working. So with that in mind, the very first one I want to go over is MOD. Now MOD 2 days ago triggered a long signal for me, but I didn't like how it didn't do as much work here near the highs as it did near the lows, and BOP was going the wrong way even with the volume surge. But the very next day, it has been moving higher, heavier, above average volume, I should say, on those 2 days, and BOP has been steadily increasing. Now, as we stand here, it's decently extended, not really necessarily from the short-term moving averages, but you can see it's slightly ever so extended from the 20-day moving average, so it's technically chasing. And since I wanted it 2 days ago, I really don't want to chase it up here at 24. So what I want to do is I want to establish a limit order at 23.42. If it gets filled, great. There's multiple support levels you can work with. There's the one right here at 22.45. Then there's 22.15. 2205, and then you can even use 2120, but 4 different support levels you can work with to really reduce your losses if MOD doesn't continue to move higher immediately, if the market continues to reverse. But MOD, pretty solid signal overall. Still, like I said, I want to keep everything small here. I don't want to put more than 2% of my account capital into any of these positions. I want to let this market play itself out sideways. If MOD holds up and base is sideways, maybe it'll give a better signal. If not, no big deal. CIFS, this is one that I tried to get long back here, failed on me here. It's now bouncing off the 50-day moving average. What I don't like about this stock is that all day on Friday when it was actually lower on the day. BOP was nicely higher than these two previous BOP sessions. By the close, though, it continued to trail off, but CIFS closed up. Now, I know it may not look like it's really coiled for a move higher, but it's a very low risk entry, so I want to get long. Limit order 45.06. First cut loss level 43.77, right there. Second and final cut loss level right there, 42.78. It goes below 42.78. I will be completely out of CIFS. Now, what I would love to see happen is to see CIFS continue to consolidate flat sideways with a BOP growing and then us get a real signal to really push it. But I doubt that happens. It's just the kind of market that we're in. You need to realize that. It's the middle of February, at least a minimum of 2 more weeks to go before we have the ideal setups. DZSI, this is also a long position. CIFS was semi-cancelum quality, also an IPO. MOD, perfect speculator quality, cancelum quality. DZSI, perfect speculator quality. So these are all relatively high quality merchandise. It's just that the market is off and the patterns aren't perfect. So you got to keep them small or not trade at all. DZSI, if BOP would have fallen to an even lower level on Friday, wouldn't have taken the trade. But it's not only higher than the session before us, but the previous session. Overall, the trend is not that good with it, but volume has been light as it consolidates. A lot of very nice intraday price action with good daily candle bars printing here at the 50-day moving average. Have the candle over candle with the heavier volume and BOP confirmation. So I want to get long DZSI. Limit order 960. Once again, we're working with multiple levels here. 917, 892 even, this one, and then that bar right there is, let's just go ahead and just bring the cursor up. So we're working with 917, we're working with 870 as the third one, the second one, 892, it makes it a little bit more confusing whenever the third stop is lower than the second stop. And then 853 as the final stop if DZSI doesn't move higher immediately. And then for all of these, MOD, CIFS, DZSI, if they lose green BOP at any point before getting to that final stop, all of the stops will be removed, and that'll be the same case if it pulls back on heavier volume. And then a thin name, KEN. I've been watching KEN since it gapped up here and started to show up in my perfect speculator scan. This is an extremely thin name, so I would consider this as informational purpose only. In fact, if anybody takes any of these trades, you're going to have to expect that they have a high chance of failing. But KEN, these are the kind of stocks I like to see when the market pulls back. Look at how well this thing is acted while the market's pulled back. Building a flat base here. Pocket pivot point signal basically right off of its 10 and 20 day moving average. Got the heavier volume. BOP has actually been increasing the past few days. Want to get long at 29.87, your first cut loss level. You could use 28.43, the low a day here. Then you could use 28.35 here. Then you could use 27.99. And if you're really brave and if you really like the stock, which I definitely don't recommend, in an extremely strong bull market, though I might do something like this, you could have a final stop at 23.96. But in this market, right there, if it goes below 28, you want to get the hell out of KEN. And then HSKA, this is an oversold swing trade. Normally, I do not like to take these stocks when they've just waterfalled with the red BOP in it and huge distribution. But this, so right here, that's why I didn't take it following the February 14th signal. Because of that waterfall, the red BOP, the heavy volume, the distribution. But now we have a candle over candle. We've had 3 straight days of very strong accumulation off those lows with max green BOP. So now I have multiple support levels to work with in case it doesn't work. So with HSKA, 62.48 will be my limit order. First cut loss level, 58.34, goes below that Friday's low a day. You're out of third. Second loss level, 58.34. Final cut loss level, 56.58. And then the final long position, the highest quality overall with a 99 earnings per share rank, with earnings per share in sales growing over 25% each quarter for the past 4 quarters. ESQ. The problem with ESQ, very simply, if you can just take a look at this chart, you should know that there's actually 2 problems with it. Very, very thin, and it can be very volatile intraday, which means you could be subject to an intraday flash crash, which shakes you out of your position, and then by the end of the day, just like on this day right here in January 29th. It'll be fine at the end of the day, closing at the high of the day. So you just have to realize it's possible that you could get shaken out of this one. You can decide not to have stop orders. I did that for a while on small cap regional bank stocks, but then there was one session where they all ate it hard, and I got hit with a pretty big loss. I think that might have been Brexit actually, in a lot of those names. But I think it was Brexit, and that's an outlier event that we'll probably never ever see again. That was just a very, very weird situation overall. So getting back to ESQ. ESQ, this was initially found in my IPO scan, not in my Cancelim scan, but after looking it up, highest quality stock out of the 6 new long positions. Want to get long at 22.83, the high of the day. And you actually have 4 stops once again to work with. 2 very tight ones, 2 super tight ones. 21.67, the first one. 21.49. 21.67 the first one, 21.49 the second one, and then even the third one super tight, 21.18, and then the final one pretty damn tight also, 20.69. So I'm not going to risk much at all to know I'm wrong on ESQ if it doesn't move higher immediately. But at the same time, if ESQ does move higher, and if this market continues to V-ramp to new highs, this is one that's going to probably do very well. In fact, all of those stocks that I just went over will probably do well. But we don't know what the market's going to do. The future is impossible to predict, so all you can do is have a game plan for any and all scenarios. Once again, if I had a small account, high commissions, I wouldn't take any of these trades. I'd want the market to be fully in position and agreeing with my stock selection. I want us to have a proper follow-through day with proper reward to risk ratios in the market along with the stocks. And so far, we just don't have that right now. So tread carefully here, everyone. If you do take these long positions, once again, keep them small. All right, I beat that dead horse to death. I will see you in the chat room on Tuesday. Aloha.